For the first time in a long time, I just added an entirely new position to my personal dividend portfolio. And to understand why I made this move, you need to understand the long-term goal for my personal portfolio. My personal goal is to one day be able to live off dividend income. That's for my dividend income to be able to pay all of my yearly expenses. And through years of research, I found that the best way to achieve this goal is to buy stocks that can rapidly increase the amount they pay out in dividends every single year. Now, there's certain qualities you have to look for in stocks for them to be able to increase dividend payouts every single year. And with the stock I just recently bought, I'm going to show you some of those qualities and why I believe it will allow me to one day live off dividend income. So let's go ahead and jump into it and reveal the stock that I just recently bought. I just recently bought United Health Group Incorporated, stock ticker UNH. This is a company currently trading at $450.05 per share. And one of the things you'll notice is over the past year, they're down around 12.64%. And as of today, they are trading very close to their 52-week low at $445. Now, if we zoom out and look at it over the past 5 years, it's done pretty well, up around 81%. And over the past 10 years, this company has done extremely well, up nearly 500%. So this company's been compounding at a pretty fast rate over the past decade. Now, if we come down here, we can see the company has a low starting dividend yield, sitting at about 1.64%. But I'm going to show you why that's not something I'm concerned about. Let's go ahead and jump over to the first spreadsheet. And this is essentially a stock screener spreadsheet. Again, you can download any of my spreadsheets on tickerdata.com, but if we come up here and plug in UNH and hit enter, and again, you can see thanks to the help of the Ticker Data add-on in Google Sheets, all this data will automatically load in. Now, right from the get-go, there's a lot we can tell about this company. We have some key metrics here that make me really attracted to this company. So we'll start off at the top line, revenue per share. How much revenue per share is this company generating? And we can see in 2013, it was sitting at about $121 per share. And in 2023, it bumped all the way up to $400 per share. So just like their share price, we can see revenue for this company has been rapidly increasing over the past decade. That's a great sign, but there's more to a company than just generating revenue. So let's go ahead and keep moving forward. We can see the same is true for earnings per share. We can see massive growth, 2013 going from $5.59 all the way up to $24.12 per share in 2023. So not only are the top lines of the income statement growing, but it's finding its way all the way to the bottom line and growing earnings per share. Now, one of the most important metrics for me as a dividend investor to look at is free cash flow per share. Now, why is that the case? Well, we have to remember there's 5 different ways that a company can reward their shareholders. 1, they can reinvest back into the business. Obviously, that's something I want to see from my companies. 2, they can buy back shares. 3, they can pay out dividends. 4, they can attempt mergers and acquisitions. And 5, they can pay down debt. So it's important for a company to grow free cash flow if they're going to be able to reward their shareholders. Since I'm personally looking for companies that can grow the amount they pay out in dividends every single year, if they're going to be able to do that, I need them to grow their free cash flow per share year over year. And again, we can see this company has done a phenomenal job of doing that, going from $5.80 in 2013 to 2023, $27.67. Now, like I just mentioned, another way that a company can use their free cash flow is to buy back shares. And we can see this is something they've been doing. Shares outstanding have decreased for this company from 2013 to 2023, which also benefits all the other per share metrics that we just looked at. So far, we're really 4 for 4 on all these metrics that we've looked at. Let's go ahead and see if that continues to be the case. Debt to assets ratio. This essentially tells us how much total debt a company has compared to their total assets. And in the case of UNH, it looks like they're pretty healthy. I don't really see any red flags in this scenario, and there's not a whole lot of fluctuation throughout the past decade, which is also a good sign. And then over here, we have essentially a profitability metric, return on invested capital. And this essentially tells us a company's ability to efficiently allocate capital in profitable investments. And again, they've been pretty steadily generating ROIC of close to around 15% for the past 5, 6, or 7 years. So right from the get-go, when we look at the stock screener, there's 6 important metrics that we see. All of them get the green check mark from me, and we'll come back and talk about some more of this just a little bit later in the video. If we jump over to my profitability and income statement sheet, there's essentially one thing I want to point out. We've already talked about how earnings per share is growing and how revenue is growing, but we also can see a little bit of consistency and even improvements in the gross profit ratios. This is something I definitely want to see from my investments. Even if revenues are increasing, if the gross profit ratio is decreasing, that's not a good sign for the company. But we can see the 10-year average gross profit ratio for UNH sitting at about 23.92, and in 2023 it was actually even a little bit better, sitting at about 24.48%. Again, another good sign for this company. So again, this is all good news, but we have to keep in mind, my personal goal is to one day live off dividend income. So let's go ahead and jump over to my dividend breakdown sheet and see if this company aligns with my long-term goals. We'll come up here again and plug in UNH and hit enter. And again, thanks to the ticker data add-on in Google Sheets, you can see all this data will automatically load in. Now, like I already pointed out, fairly low starting dividend yield sitting at about 1.67%. So when we're looking at companies with lower starting dividend yields, that isn't necessarily a bad thing if they can rapidly increase the amount they pay out in dividends. And if we come down here and look at the yearly dividend payout chart over the past 10 years, we can see that has definitely been the case. This company was paying out $1.05 per share in 2013. Okay, and when we look at where they are in 2023, $7.29 per share, and their most recent dividend hike put them at $7.52 per share. So over the past decade, this company has nearly 7x'd the amount they pay out in dividends. So in a very short amount of time, we can see the amount they pay out in dividends has absolutely exploded. We can see their 10-year dividend CAGR from 2013 to 2023 sitting at 18.26% and the 5-year 12.68%. So this is a company rapidly increasing the amount they pay out in dividends every single year. Now, like I just pointed out on the stock screener tab, in order for them to be able to do that, they have to grow their free cash flow per share at a pretty rapid rate as well. And we can see that's been the case for this company. The 10-year free cash flow CAGR sitting at about 16% and the 5-year at around 13.5%. And this is best graphed out when we look at the free cash flow versus the dividends paid out chart. Again, like I mentioned earlier, dividends are paid out of free cash flow. So this essentially gives us a visualization of how much free cash flow is being used to pay out dividends. So for example, we can see this company generated around $5.8 billion in free cash flow in 2013. Now in 2013, it looks like they paid out around $1 billion in dividend payments. So in 2013, that gave them a free cash flow payout ratio of around 18.11%. So that means 18% of their free cash flow was being used to pay out dividends. So that still leaves around 80% of the free cash flow left to do things like reinvest back into the business, buy back shares, pay down debt, and attempt mergers and acquisitions. So this company is paying out rapidly growing dividends, but still has plenty of other options with ways to use their capital. And again, we can see how this free cash flow versus the dividends has been growing over the past decade as well, with 2023 generating over $25.6 billion in free cash flow and dividends paid out at around $6.7 billion, and that gave them a free cash flow payout ratio in 2023 of around 26.33%. So this free cash flow payout ratio has stayed in a very healthy range over the past decade. That's exactly what I want to see from my investments. Now, while we're on the topic of free cash flow, if we jump back over to my stock screener tab, come over here, we can see free cash flow per share in 2023 for this company sitting at about $27.67. Now the current trading price for the company sitting at $450.05. This means they have a free cash flow yield sitting at about 6.15%. Now, I haven't talked about free cash flow yield a lot on the channel before, but this is something I want to start touching on more because I think it can tell us a lot about a company and its valuation and the type of returns that it's giving you. Now, the formula for free cash flow yield is pretty relatively simple. You simply take the free cash flow per share and divide by the price per share, and you get free cash flow yield. And generally speaking, this basically tells us how much free cash flow an investor is receiving based on the price they paid per share. And for UNH personally, I think a free cash flow yield of around 6.15% is pretty solid, but here's what we have to consider as well. This is a company that has a 10-year free cash flow CAGR of around 16%. If this company can continue to increase the amount they generate in free cash flow every single year, then your free cash flow yield on cost will continue to increase over time. So just like dividend yield on cost can increase over time, so can your free cash flow yield on cost. Now let's look at a company that is essentially the opposite of UNH when it comes to free cash flow yield. If we come up here and plug in VZ, that is stock ticker for Verizon. Again, all this data will automatically load in, but if we come over here, we can see the free cash flow yield for this company sitting at about 10.96%, so pretty close to around 11%. That is a high free cash flow yield. So maybe on the surface level, you're thinking, okay, Verizon might be a pretty attractive investment opportunity. I'm receiving a lot of free cash flow for the price that I paid for this stock. But here's something you have to consider. Look at the free cash flow per share for Verizon over the past decade. It's jumping all over the place and it's definitely not growing. In fact, if we jump over to the dividend breakdown, come over here and plug in VZ and hit enter. If we come over here and look at the 10-year free cash flow CAGR, there's essentially been no growth, and the same is true for the 5-year free cash flow CAGR. So when we look at the free cash flow yield for Verizon, we know this free cash flow yield is not going to be increasing over time because their free cash flow is not increasing over time. If they don't increase free cash flow, then the free cash flow yield on cost will stay right at around 10.96%. While on the other hand, UNH's free cash flow yield on cost in just a few years will hit around 10.96% and continue to grow even more. So the free cash flow you're receiving on a per share basis continues to increase every single year, leading to a higher free cash flow yield on cost. Now, with all that being said, Why is the company down 12.64% over the past year and trading right at its 52-week low if it's such a great company? I mean, for example, if we look at the S&P 500 over the past year, up around 25.51%. So that's a pretty large difference between the S&P 500 and UNH. So what exactly is going on with this company? And I think this potentially has to do with three different things. Problem number one is United Health has paid more than $3 billion to providers following a cyber attack. And this is pretty recent news. We can see this was as of March 27th, so just a few weeks ago. If we scroll down just a little bit, we can see United Health, which owns Change Healthcare, discovered in February that a cyber threat actor had breached part of the unit's information technology network. So obviously this was a pretty big deal, and this has led to around $3 billion they've had to pay out. Now obviously $3 billion is a lot of money, but we have to keep in mind UNH is a massive company with around a $400 billion market cap. And if we use the ticker data function to automatically bring in the cash and cash equivalents for UNH as of 2023, we can see this company sitting on around $25.4 billion in cash and cash equivalents. So it's not like this company didn't have the capital to pay this out. Now problem number two with this company is they recently saw a pretty large price drop due to a report of antitrust probe. If we scroll down, we can see again, this is relatively new news, but they dropped 5% in a single day after this antitrust news broke. And then problem number three is what some analysts have been saying is a problem for UNH. We recently saw a Medicare rate decision that pushed the share price down for UNH. And if we scroll down, we can see this is after the Centers for Medicare and Medicaid Services set a lower than expected reimbursement rate for privately run healthcare plans for 2025. So now at first glance, obviously all three of those points aren't good news for the company, and it is somewhat understandable we have seen a share price decline. But if you're a long-term investor looking to one day live off dividend income, here's the question you need to ask yourself. How will this company be affected long-term, and is it going to prohibit their ability to continue to increase dividend payments at a high rate moving forward? And when I look at the fundamentals of this company, I just don't think that is the case. I think this company will be completely fine increasing their dividend payouts over time. Now, with all of this being said, we still want to answer the question, is UNH trading at $450.05 per share still trading at a good value? So let's go ahead and run to my valuation models and see if we can find the intrinsic value for this company. If we come down here, first off, we want to point out beta is sitting at just 0.55. So this company typically sees pretty low levels of volatility. Again, if you're an income-oriented investor and you're close to retirement, that's probably something you like to see. Now, the first valuation we'll run this through is going to be Graham's valuation. Let's go ahead and zoom in and come over here and take a look at this. Again, we can see our estimated earnings per share average, our growth rate projection, and then we divide all of this by Y, which is the current yield on AAA corporate bonds. And when we plug all this in, we come to an intrinsic value of $445.54, which is actually pretty close to the trading price for this company as of right now. But if we look at the discounted cash flow analysis, we get another story. Let's go ahead and zoom in. Now, again, we have to keep in mind this company has seen very fast free cash flow growth over the past decade at around 16% and 5 years, around 13.5%. In this scenario, I was being a little more conservative with my projections. I applied a free cash flow growth rate of just 8% to the future free cash flows of this company. And after finding the present value of those future free cash flows and adding them together, adding the company's cash and cash equivalents and subtracting out their total debt, we get the equity value, divide by shares outstanding, and I come to a DCF price per share of $616.13. So again, that's quite a bit above the current trading price for this company. Now, the next one we'll look at is going to be our multiples valuation. And this is an interesting one because I don't think there's a perfect comparable for this company due to its size. A lot of these comparable companies are considerably smaller than UNH. Again, UNH has a market cap of around $400 billion, and I think all four of these actually are either around $100 billion or even lower. But with that being said, we can see these comparable companies have an average price to earnings of around 17.59. So that's how the market is valuing these comparable companies. If we jump back over to the stock screener tab and scroll down, we can see UNH has a price to earnings of 21.83. So if we applied the same average PE to UNH, we'd come to an intrinsic value of $424.36, again, a little bit lower than the current trading price for this company. But lastly, let's go ahead and look at our dividend discount model. I'll zoom out just a little bit. And again, the idea behind this valuation is we should be able to value a company based on how much they pay out in dividends and how much that dividend payment is increasing over time. And like we've already pointed out, the dividend has been growing pretty rapidly for this company over the past few years. So assuming a dividend growth rate of around 7% and a discount rate of 8.5%, we come to a dividend discount model price per share of $536.43, a decent bit higher than that current trading price. So when we jump over to the output tab for this company, we can see all four valuations, When we average them together, we come to an intrinsic value of around $505.61. Now, that's around 11% higher than the current trading price for this company. So with a 10% margin of safety, you could see an acceptable buy price of around $455. So it looks like it is within our acceptable buy range with a 10% margin of safety. With a 20% margin of safety, you might want to wait to see it come just a little bit lower, but in my opinion, the fundamentals for this company are so strong, I feel perfectly fine buying it with around a 10% margin of safety. If we jump back over to my do-it-yourself investor toolkit, again, you can download this on tickerdata.com, but if we go over to my dividend dashboard and go ahead and zoom in just a little bit and scroll down, we can see this new addition to my personal portfolio adds around $52.64 of annual dividend income. And that's because I bought 7 shares of this company. And if I see them go even lower in the following months, I'll plan on adding more. So when I evaluate my portfolio and consider my long-term goals, investing in UNH kind of seems like a no-brainer to me. Those dividend payments are safe and sustainable, and I expect them to grow at a very high rate moving forward for years to come. Over the short term, market price is often driven by news sentiment, which is why we can see this company is down around 12.64%. But long-term share price growth is driven by earnings per share growth and free cash flow per share growth, which is also the exact same reason over the past 10 years we have seen them outperform the market up around 500%. So go ahead in the comments down below and let me know what you think of this new position in my personal portfolio, if you plan on buying it or staying away. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the Ticker Data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.